What is the Federal Reserve System? It is also known as the Fed. The Fed is the central bank for the United States of America. It is the bank for all banks in this country, as well as the bank for the federal government. It was created to help stabilize our financial situation. Meant to keep our money safe and our best interests in mind, the Federal Reserve System gives us a safe, flexible, and stable financial system. The Federal Reserve System is a group of 12 different Federal Reserve banks and a number of branches that is managed by the Board of Governors. These reserve banks are the operating arms of the central bank. So to break it down, there are 4 components that make up the Federal Reserve System. First, there are 7 members on the Board of Governors, and they set monetary policy. Next is the 12-member Federal Open Market Committee. They set the federal funds rate that is charged by the Federal Reserve banks. Then there are 12 regional member banks which are located throughout the United States as part of the Federal Reserve System. Lastly, there are staff economists who provide reports to Congress. The Fed is an unusual mixture of public and private elements. Who created the Federal Reserve and when? Congress created the Federal Reserve Act in 1913. President Woodrow Wilson signed the act on December 23rd, and it went into effect the following year, 1914. It took almost an entire year from the time President Wilson signed the act to figure out where the boundaries of the 12 Federal Reserve districts would be, and then to establish each of the 12 regional reserve banks. At the time that it was signed into law by President Wilson, the Federal Reserve Act was the first major act of law which tried to create a central bank to control and monitor the currency system within the United States. Before this, the nation had implemented 2 central banks, the first in 1791 and the second in 1816. These 2 banks of the United States both dissolved in the middle of debates over whether a central bank was equal to a money monopoly. To many people, the idea of a central bank was a threat to democracy. They felt like having a central bank would concentrate the nation's wealth into the hands of just a few powerful people. Once the Second Bank of the United States dissolved, the economy went through a great deal of turbulence. At times, financial crises crippled banking in certain parts of the country. But in other parts of the country, people prospered. It was an unstable financial ride full of ups and downs that caused widespread panic in 1907. The Federal Reserve Act was created mostly in response to these series of financial panics. As time went on, the responsibilities and duties of the Federal Reserve System have grown and changed. Its central composition has evolved. Different events such as the Great Depression were major factors that led to changes in the system. What are the responsibilities of the Federal Reserve System? Well, originally it was created to address the banking panics, such as the one in 1907. The Federal Reserve Act also stated that it was to furnish an elastic currency, to afford means of rediscounting commercial paper, to establish a more effective supervision of banking in the United States, and for other purposes. That basically means that the Federal Reserve is responsible for guiding the people through the nation's economic policy by striking a balance between private interests of banks and the centralized responsibility of government. They do this to keep prices stable, keep interest rates relatively low, and to help maintain employment. Perhaps the most important and visible function of the Federal Reserve System is to control inflation without triggering a recession. The Fed also supervises the nation's banking system to protect consumers by making sure the banks are safe places to keep people's money, as well as protecting credit rights of consumers. Today, the Federal Reserve System is also responsible for other actions. They provide financial services to depository organizations, the U.S. government, and foreign central banks. Some of these services include playing a key part in clearing checks, processing electronic payments, and distributing coin and paper money to the nation's banks, savings and loan associations, and credit unions. The Federal Reserve System also researches and studies the United States and regional economies. It shares information about the economy through various publications, speeches, educational seminars, and websites. The Fed is there to strengthen the United States' standing in the world economy. The Federal Reserve System has a few branches or parts to it. There's the Board of Governors, the FOMC, the 12 district reserve banks, member banks, and other depository institutions, American people. What is the Board of Governors? Who are the members? The Board of Governors, also known as the Federal Reserve Board, is the group that manages and supervises the Federal Reserve System. The President appoints 7 members or governors to the board, and the Senate must approve of his choices.
Raise your right hand and repeat after me. I, Ben S. Bernanke,
I, Ben S. Bernanke,
do solemnly swear that I will support and defend the Constitution of the United States
that I will support and defend the Constitution of the United States
against all enemies, foreign and domestic,
against all enemies, foreign and domestic,
that I will bear true faith and allegiance to the same,
that I will bear true faith and allegiance to the same,
that I take this obligation freely, without any mental reservation or purpose of evasion, and that I will well and faithfully discharge the duties of a member and of the chairman of the Board of Governors of the Federal Reserve System. So help me God. Congratulations.
The Fed's action touched the lives of all Americans, and the chairman of the Federal Reserve must be a leader of unquestionable credentials, sound judgment, and impeccable character. Ben Bernanke meets those high standards, and he will be an outstanding chairman of the Federal Reserve. As chairman, Ben follows in the footsteps of one of America's most respected public servants. Alan Greenspan is perhaps the only central banker ever to achieve what one publication called rock star status.
A board member serves a term of 14 years, and after serving a full term, he or she may not be reappointed. Appointments to the board are staggered so that one term expires on each even-numbered year, 2012, 2014, and so on. The chairman, as well as the vice chairman, leads the board. The nominees for these positions are current members of the board. These positions take term for 4 years. However, they can be reappointed for an additional 4 years, as long as their member term is still active. Remember, that is a term of 14 years. The President and the Senate must approve of these appointments as well. The Board of Governors, which is located in Washington, D.C., provides the leadership for the entire Federal Reserve System. It has several responsibilities. They analyze domestic and international economic and financial conditions. They also guide monetary policy action. In 1980, the Monetary Control Act gave the board the power to set a reserve requirement. That means banks now have to set aside a certain amount of cash in reserve. The reserve balance that banks must keep is typically a percentage of their total interest-bearing and non-interest-bearing checking account deposits. In other words, the amount of money a bank has to keep in reserve fluctuates depending on how much is in their total accounts. This means the bank will always be able to give you your money when you ask for it. The board also approves the discount rate, which is the interest rate that a regional reserve bank charges banks and financial institutions when they borrow funds on a short-term basis. The Fed discourages banks from borrowing except for occasional short-term emergency needs. Changes in the discount rate can affect lending rates and other open market interest rates because it is a visible announcement of change in the Fed's monetary policy. Higher discount rates point toward more restrictive monetary policies are coming up, while a lower rate might signal a less restrictive move. The board exercises supervisory control with financial institutions, regulating them to protect consumer credit through the Equal Credit Opportunity Act and the Truth in Lending